This is the Financial Sense News Hour with the president of PFS Group, Jim Poplava. Since 1982, PFS Group has offered asset management and educational resources that have helped investors build, maintain, and preserve their wealth. Now, here's the Financial Sense News team, Jim Poplava and John Leffler.
Hi, everyone, and welcome to the second part of a special edition of the Financial Sense News Hour. As I mentioned in the first hour, we were putting together a special program, and I was trying to get together individuals in the industry together with Commissioner Bart Chilton. Unfortunately, that did not happen. We just couldn't get everybody's schedules to mesh. So I did do a separate interview with Commissioner Chilton earlier in the year, and now what we're going to do in this hour is we're going to take some of the clips of my interview with the commissioner, and I've invited Dave Morgan from Silver Investor and the Morgan Report and Eric Sprott from Sprott Securities, and I've asked them to respond to some specific questions that dealt with silver manipulation, dealt with over-concentrated short positions, in some of the anomalies that have gone on in the silver market, and get each of them to comment to the commissioner's response, because I do believe that Commissioner Chilton is trying to do a good job. This is sort of what we call our virtual roundtable, since we couldn't get everybody together all at once. But what you're going to hear now is both Dave Morgan and Eric Sprott comment on what the commissioner responded to me in the questions that I asked. Commissioner, I want to start out. You've been on record and you've been conducting an ongoing investigation of what might appear to be manipulation of the silver market. You have testified over the last couple of years, and I'm taking a quote here: there have been fraudulent efforts to persuade and deviously control that price. Commissioner, what are the factors that lead you to that conclusion?
Well, Jim, in general, people have emailed me over the years, but this dates back all the way to 2007 and then significantly in 2008, and they would predict that prices would move up or down based upon what they saw in the market. And while this did not occur 100% of the time, it occurred significantly enough that it made my antenna go up, and I started asking our Division of Market Oversight to surveil the matter and to look at it, which they do in general, Jim, on all the markets, but with a specific regard to when I would get these emails that would forecast such price changes. So it's based upon public information and things that I've received actually from individuals across the country, in fact across the world, that I believe that some of these things have gone on that you mentioned there in my statement.
Eric?
Well, Jim, I'm sure he's referring to, when I hear a conversation like that, the thing I think of is Andrew Maguire, who, of course, sent letters to the SEC saying that the price of silver will be bombed on this particular day at this particular minute, and sure enough, it happened. And when Andrew Maguire went back to the SEC and said, well, did you get it? What are you going to do about it? Of course, there was blank stares and faces all around, and nothing happened. And I guess various people have written into Commissioner Chilton, and he's partially buying in. But I find it a little surprising that if you even partially bought in as one of the five commissioners, you might think that you might press the issue a little harder. As we all know, there's already lawsuits charging HSBC and JP Morgan with manipulating the silver market in 2008. That's in the public domain, so there's nothing new there that anyone can't research. And also there's 4-year or 3.5-year investigation into manipulation of the silver price by the CME with no conclusion. So, yes, I can see why he would imagine that could happen, and I do appreciate that he made a very blunt statement about what he thought might have happened, and it will be interesting to see whether it plays out exactly as he stated, that there have been fraudulent efforts to manipulate the price of silver.
Dave?
Well, I appreciate, the fact that he takes it to heart and that they've been, he asked the Division of Market Oversight to look into the matter. The problem I have with it is how long they have to look. I mean, it's pretty straightforward that the rules that are already established require that there be limits, and these limits are being overrun. Now, it is a bit technical because there are a couple of categories. First category is basically your speculative category, and then there's a true hedger category. The hedger category doesn't have exemptions, but they have bonuses, I'll call them. This is my word, bonus. The bonus is if you're a bona fide hedger by their definition, meaning the CFTC's definition, you do not have to put up as much margin as you do if you are a speculator. So you get like a 30% gift, meaning that you are only required to put up 70% as much capital as a speculator is. So that's a bonus right there. The other bonus is that they don't really have a certified amount that they can hedge if you are considered to be a true hedger. The problem with all of that is it's an unfair playing field. And secondly, who is determining whether or not someone is a certified hedger or not? Most of the true hedging that goes on through these markets are through the base metal companies. These are, for example, your BHPs. Now, these companies produce a tremendous amount of silver. However, commensurate with their bottom line, in other words, how much it actually produces a profit in the company, is almost ridiculous. I did a study several years back, so I want to give the idea, but not the exact number, because numbers change, and I haven't done this study in quite a while. But I looked at silver like tripling, and with that huge 300% increase in the price of silver, the bottom line increase into a BHP was almost insignificant, because silver is such a small portion of what they mine out of the ground. But silver is a small market, and what they take out of the silver market, what they produce in a given year, is significant. So I hope I'm making a lot of sense here on how these really big conglomerates mine a great deal of silver, yet they have very little interest in the metal, so they turn that interest over to bullion banks for the most part. Now, the bullion banks now have this exemption to go in and hedge, I'll put that in quotation marks, the silver market, which gives them, I believe, a huge advantage, because they know basically what the majority of the silver production is going to be. They also have no restrictions on can they hedge 1 year, 5 years, 10 years, 50 years. There's no limit. So all these things have to be really considered. I'm not sure how deeply the CFTC has actually looked into that aspect of it. I've thought about this for years. I haven't really written about it in a long time, because my view is that the bureaucracy that exists is not going to take action in a sufficient amount of time where it's actually going to do us any good. I hate to sound negative, but that's my take. It's opinion only. But so far, we are still waiting.
You know, since I've been investing in the silver market over the last decade, Commissioner, there appears to be at least 3 to 4 large entities that make up most of the short positions in silver. And I don't know if it's simply a large bank that is representing its clients. For example, it could be hedge funds or some large institutions. But at times, some would argue these positions have been so concentrated. Does that strike you as being odd sometimes when they get that large?
I wish it was odd. It's actually not odd, because it's been so prevalent, Jim. It's deeply concerning. I mean, these monsters of the market are at sometimes 25, 30% of a market. Now, there are folks out there, and even some people at the CFTC, but there are analysts out there who will say that 25 or 30% of the market isn't a problem. But I am just absolutely convinced that that significant concentration can push markets around, up or down, and that's why the Commission just recently, in the last couple of months, has approved limits on the concentration that can be held by any one trader.
Dave?
Well, this one really gets to me. First of all, there is limits on the long side. The long side, of course, is that you're buying silver. And as a quick example, and you'll have to read it to verify this, but if you go to the rules on silver at their website, you'll find that you can only have 1,500 contracts available to any long trader. So that's 7.5 million ounces of silver. That's it. It's a limit. It's in writing. When you sign up to get a futures account, that's what you're signing into. So there is a concentration limit for the longs. But on the short, there is no limit, basically, as we talked about in the previous question. But I want to drill down on this concentration situation a little bit deeper, because, Jim, as you know and most of the listeners know, I have a fairly good background in the commodity sector. There's a gentleman that is named Ken Roberts. Ken based in Oregon. In fact, one of my futures brokers, one of the two that I have that are in Chicago, used to work for Ken. Ken has been quite a successful commodities trader over the years. In fact, he used to sell some educational products along those lines. And when he really got started in the commodities, and not at a really deep level, he was in the cattle market. And he was, I believe, if I remember the story right, pretty young, and I think he was still in college, but you can scratch that. That's from my memory. He was taking such a good position, edging into the market, accumulating positions, that the authorities came to pay him a visit because he was too big a player in such a small market. In other words, the concentration on the long side was concerning them that one player could influence the market that much. If one player can influence, or concentration can influence the market, and it can, there's no doubt about that, then they have to look at both sides. They have to look at a concentration on the long side, and they have to look at the concentration on the short side. And yet, they continually seem to only be able to focus on any concentration from the long side. For example, oil, that was the speculators that were causing the price rise. Well, it was more buying and selling, and that is what moved the price up, and speculation probably did have something to do with it. But it seems as if they're blinded to the short side. The market works both ways. The commodities market is really the only zero-sum game investing that I know of. In the stock market, you can be in an investment, and if the business actually grows, all investors can get, more, can build their wealth. But in the commodities market, for every long there's a short, for every winner there's a loser, and it's a zero-sum game. If I win 100, you lose 100 if we're on the opposite side of the same contract. So that really does bother me that he give an answer that's the status quo, and it's too bad, and that's the way it's been, because it isn't that way in all the markets. It has become that way in a lot of the markets. I don't want to disagree with them totally, but it's something that they should have been on top of a long, long time ago. And again, it goes back to their basic rule book. I mean, they should read their own rule book and see what it says about concentration.
Eric?
Well, yes, that was suggested that they would impose that limit. Of course, it's already been pushed out. I think they're not even going to consider it until June again. And it's incredibly obvious. The person who's done the best work on this is Ted Butler. And he's made comparisons between the largest positions in oil versus the largest positions in silver, and the oil positions are nothing like 25 to 40%. It's almost incredulous that anyone would need to be short that amount of silver. I mean, we're talking 200 to 350 million ounces. Everyone's aware that's done the analysis that these 4 or 5 institutions taken those positions. That's what caused those lawsuits to be launched regarding 2008. I think that's what's caused the investigation to be launched by the CME that's been ongoing for 3.5 years. So there's no doubt that the silver market has got a massive overconcentration of shorts, and I really credit all the work to Ted Butler, who's kind of gone there to expose the various things that have gone on in the market.
Eric, it's interesting that you bring that up, and he talks about this position, which at times can represent up to 35% of the market. About 2 weeks ago, there was a one-day event in the market where 45,000 contracts of silver were sold short, representing 225 million ounces of silver. Now, what is strange about that, and what I find, I guess, mystifying, is there's only about a little over 30 million ounces for delivery against that short position. So to me, allowing whatever entities, these 2 or 3 entities that are involved in this, to short that much silver when there's not that much available. For example, Eric, what would happen if someone like yourself was on the buy side and said, I'd like that silver? You wouldn't be able to get it.
It's actually one of my missions in life, quite frankly. But the more interesting thing, even, you mentioned the roughly 225 million ounces of silver that traded with annual production of about 900 million ounces. So, but the interesting thing is it occurred in 1 hour. And to imagine that 1/4 of the world's silver production was traded in 1 hour is almost beyond belief. 2, when GFMS and other groups put out the silver data, they say that I think last year, for example,